The process of transforming an existing business into an asset of value include 4 steps. Complete a valuation of the business in its present form. Identify value detractors, the factors that detract value from the business. Develop a vision of what the business must look like in 3 to 5 years. And craft an exit strategy aimed at realizing value for the current owner of the business. Day 1. Business valuation and value detractors. Business valuations for small businesses have limited application, but we need a starting point. In this section, we need to come to grips with the value the business represents to the current owner, specifically the income derived from the business, the low or fire sale value of the business, what the owner will realize by liquidating the business in its present form, and the high or profitability multiplier value, the theoretical value of the business as though no shortcomings exist. The business in its present state generates financial benefits for the owner, which may consist of a combination of a salary and other benefits. It is common for business owners to include personal expenses in business accounts. We will return to this subject later. In this case, total directors' drawings amount to 998,000 Rand per annum, which leads us to ask, how much capital will be required to replace the current financial benefits or income of the director? Assuming an annuity rate of 9% per annum, which is on the high side, a total of 11 million Rand will be needed to replace the current income of the director. From the perspective of the business owner, this value of 11 million Rand is what the business is worth. But how much capital may be realized from selling the business? I consider 2 values: a low value or fire sale value and a high value or a profitability multiplier value. First, we consider a fire sale value, as though we sell the assets of the business at an auction. How much money will remain after settling all liabilities? To make this calculation, we look at the statement of financial position and consider the value of assets minus liabilities. We may have to make some adjustments if, like in this example, the business owns and has financed a vehicle that the owner uses and intend to continue using for personal purposes after exiting the business. After making these adjustments, we arrive at a fire sale value of 585,000 Rand. This represents the low value of the business, the value the owner would realize if the business had to be liquidated. Next, we consider the high or profitability multiplier value of the business. Here we turn our attention to the profit and loss statement, and more specifically to operating profit as a proxy for earnings. But we need to consider operating profit over at least 3 consecutive years to arrive at an average. We must also adjust the earnings by adding the total director's drawings as calculated earlier to arrive at the adjusted earnings. The profitability multiplier method of business valuation is predicated on the principle that the value of an asset may be derived by applying a rate of return to the earnings generated by the asset. In the South African context, it is reasonable for an investor to expect a rate of return of at least 25% per annum, since investing in a private company is generally seen as high risk. Therefore, investors demand to be rewarded for taking on the risk with a high rate of return. And so we arrive at the gross value of the business. We may adjust the gross value by adding assets and subtracting debt to arrive at the net value of the business. The next question to ask is, how much income may be derived from this value? Applying the same method and annuity rate as before, but by doing so now in reverse, we may calculate the potential earnings that the director can generate by investing the proceeds from the sale of the business as just over 486,000 Rand per annum, which is well short of the current income that the business generates for the director. The total director's drawings of 998,000 Rand per annum as calculated before. Nevertheless, the capital that the owner of the business may realize from selling the business is likely to fall between the low fire sale value and the higher profitability multiplier value. What will ultimately determine the selling price of the business are the factors that detract value from the value of the business. Now, let's consider what common factors detract from the value of smaller businesses. Firstly, dependency. For many smaller businesses, the most profound detractor of value is the dependency of the business on the business owner. Consider a scenario where a business owner assumes responsibility for sales, operations, and finance. The business owner is doing 3 jobs. I remember being in a similar situation. When I was out selling, I neglected operations. When delivering services, I neglected finance or compliance. I did 3 jobs, none of which very well. Nobody is good at all aspects of running a business. Often, entrepreneurs come from a sales background, being exceptionally good at closing deals and managing relationships. But salespeople are notoriously bad at admin. Savvy entrepreneurs, potential buyers of businesses, understand that customers do business with people they like and trust. If the majority of customer relationships vest in the current owner, what guarantees do the new owner have that existing customers will continue to support the business? What if the seller decides to join a competitor business and the customers follow him there? Existing customers are under no obligation to continue buying from the business. If the current owner is in effect doing all the work on which the operation of the business depends, what exactly is the new owner buying when the current owner leaves? Not much. Used operational assets, mostly. The result is that the business is worth no more than the market value of the assets, a fire sale value. The next factor that detract from the value of the business is transferability. On a rudimentary level, a business consists of people with the right skills and character traits to do the work, processes, tasks done in sequence to produce the product or deliver the services, and policies, the rules about how things are done in the business. As an accomplished business owner, you have developed skills. You have learned lessons. You run the business by the seat of your pants, on intuition. The decisions you make with regard to suppliers, pricing, employees, customers, and money matters are all informed by knowledge built up over many years and residing deep within the recesses of your brain. You know what to do next, and keep track of tasks in your head. And you can. because you've been doing it for so long. But knowledge, skills, and experience vested deep within the person of the business owner is no good to whoever must take over from you when you sell the business. The continued success of the business depends in large part on a transfer of knowledge. A business where all the skills and knowledge leaves with the current owner at exit is worth no more than the market value of the assets, a fire sale value. The next factor to consider that detracts value from the business is customer concentration. In the world of small businesses, sales success is often a function of customer relationships. Entrepreneurs with strong people skills build and maintain long-standing relationships with key customers. And since the business owner must juggle various plates, roles concurrently, time available to selling is limited. The result is that the smaller businesses end up depending in large part on sales revenues originating from a small number of loyal customers. This represents a real risk to a prospective buyer of the business. As mentioned before, customers are loyal to individuals with whom they have a strong relationship, not with a business. The new owner has no guarantee that the customers will continue to buy from the business when the original owner leaves. The next factor we consider is indebtedness. Financiers providing debt finance solutions to businesses will almost always insist that the owner of the business accept personal responsibility for the business's debt by way of a personal surety or by providing an asset as collateral or security for the debt. Financiers are typically not prepared to transfer liability for the business's debt to a new owner, and certainly not without assessing the credibility of the prospective buyer of the business. Typically, prospective buyers look for a business clean of any debt, where the current owner settles all business debts at exit. The last factor that we consider that detracts value from the business is muddled up records. Very often, entrepreneurs put personal expenses through business accounts. This is very problematic from the perspective of an external party reviewing the financial and business bank account statements to determine the value of the business. It's not possible to quantify the negative effect of value detractors. Suffice to say that the value of a business is quickly and severely eroded. In the next installment, Day 2, we consider how to develop a vision of what the business must look like in 3 to 5 years to attract the favorable attention of investors. To watch the full series, visit Constructum Online Learning on YouTube or click on the link in the post.